In March 2023, Silicon Valley Bank had $209 billion in assets. 3 days later, it had nothing. Not struggling, not illiquid. Gone. The 16th largest bank in America vanished in 72 hours. You probably heard it was a bank run. Panicked customers withdrew their money too fast. Classic crisis. Except that explanation skips over the most unsettling part. The money they were trying to withdraw didn't actually exist. It never did. And that's not a bug in the system. That's how every bank in the world operates, right now, including yours. Here's what you think happens when you deposit money at a bank. You hand over $1,000. The bank puts it in a vault with your name on it. When you need it back, they give you your $1,000. Simple, safe, logical. That is not what happens. When you deposit that $1,000, the bank keeps maybe 100 of it, sometimes less. The rest, they lend it out to someone buying a house or a business expanding or another bank that needs cash for a few hours. Your money becomes someone else's mortgage. And here's the twist. That person's mortgage also shows up in their account as money they can spend. So now your original $1,000 exists in two places. Your balance hasn't changed, but the total amount of money in the system just increased. This is called fractional reserve banking, and it works beautifully until everyone wants their money at the same time. Because the truth is simple and uncomfortable. Banks don't have your money. They have a percentage of it, a pile of promises, and a prayer that you won't all show up on the same day. Let's slow down and follow the actual mechanics. You deposit $1,000. The bank is required by law to hold a reserve portion. In the US, that reserve requirement was 10% for decades. In 2020, the Federal Reserve dropped it to zero. Zero. That means, technically, a bank could lend out every single dollar you deposit and hold nothing back. Most don't go that far, but they're not required to hold anything. So let's say your bank holds 10% to be conservative. They keep $100. They lend out $900 to someone else. That $900 ends up in another account at another bank. That bank keeps $90 and lends out $810. That $810 gets deposited again. $81 held, $729 lent out. Your original $1,000 has now created nearly $2,710 in total account balances across the system. Economists call this the money multiplier effect. It's why the total amount of money in circulation is far higher than the physical cash that exists. In the US, there's about $2.3 trillion in actual physical currency, but total money in checking and savings accounts? Over $18 trillion. The gap between those numbers is belief, confidence, the assumption that the system keeps working. And most of the time it does, because most people don't withdraw everything at once. Banks can shuffle money between each other. They borrow from other institutions overnight. They top emergency credit lines. The whole apparatus hums along invisibly, until it doesn't. Here's what breaks the machine. Imagine a rumor starts. Doesn't even have to be true. Someone tweets that your bank is in trouble. A news article mentions liquidity concerns. Maybe a hedge fund quietly pulls out. You check your account, balance looks fine, but then you think, what if everyone else panics? So you withdraw your money, just to be safe. And that's rational, completely rational. But if enough people do it at the same time, the bank runs out of available cash, not because they're broke, but because they can't sell their assets fast enough. Remember, your deposits aren't sitting in a vault. They're tied up in mortgages, business loans, government bonds. Those assets are worth something, but turning them into cash takes time. Silicon Valley Bank had billions in treasury bonds. Those are as safe as it gets. But they were long-term bonds bought when interest rates were low. When rates spiked in 2022, the value of those bonds dropped. SVB could have held them to maturity and been fine, but when depositors started pulling money out, they had to sell those bonds now, at a loss, which made the bank look weaker, which caused more withdrawals, which forced more bond sales. A feedback loop. And once it starts, it's almost impossible to stop. On March 9th, SVB announced they'd sold $21 billion in assets and lost $1.8 billion doing it. They tried to raise fresh capital to cover the gap. The market panicked. Depositors pulled $42 billion in a single day. By March 10th, the bank was insolvent. $42 billion withdrawn in 24 hours. That's not a line of people at a branch. That's wire transfers, mouse clicks, the speed of panic moving at the speed of the internet.
Now, here's where it gets strange. After Silicon Valley Bank collapsed, regulators stepped in. The FDIC took over, and they made an announcement. Every depositor would be made whole, even the ones with accounts over the $250,000 insurance limit. Which sounds like a happy ending, but pause on that. Where did that money come from? The FDIC's insurance fund had about $128 billion in it. SVB depositors had $175 billion. The math doesn't work. So the government essentially backstopped the entire thing. Not taxpayers directly, but through mechanisms that ripple through the system. They didn't call it a bailout, but depositors got their money, and the message was clear. If you're big enough or important enough, the system will bend to keep you whole. Which creates a moral hazard, because now every bank knows, if things go truly wrong, someone will step in. Except they won't always, or they can't. Or they'll decide this time is different. In 2008, Lehman Brothers wasn't saved. Bear Stearns was. Why? The reasons are complicated and political, and depend on who's in the room when the decision gets made. You'd think there's a rule book. There isn't, not really. Zoom out for a second. We've built a financial system that only works if most people don't use it all at once. Your access to your own money depends on collective calm. That's not necessarily bad. It's efficient. It allows credit to flow. It helps people buy homes and start businesses without waiting for someone else to save up the full amount first. But it's fragile in a specific way. Not fragile to slow declines or bad loans or recessions. Banks can weather those. They've weathered those for centuries. It's fragile to speed, to information moving faster than institutions can react. In 1930, a bank run took weeks. People lined up outside. Rumors spread by word of mouth. Banks had time to call in loans, sell assets, borrow from other banks. In 2023, a bank run took 24 hours. Because the money isn't physical, it's digital, and fear moves at the speed of a push notification. Silicon Valley Bank failed faster than any bank in modern history, and it wasn't even a complicated scheme. No fraud, no hidden bets, just a mismatch in timing and a loss of confidence. Here's the question no one wants to ask out loud. If it happened that fast to the 16th largest bank in the country, what happens when it's a top 5 bank? What happens when it's 3 banks at the same time? There aren't enough reserves, there isn't enough insurance, there isn't enough emergency credit to stop a synchronized collapse if confidence breaks in multiple places at once. And the speed problem isn't getting better, it's getting worse. Every year, money moves faster, platforms are more connected. A rumor in Hong Kong can trigger withdrawals in San Francisco before breakfast. So what really happens when a bank runs out of money? Technically, it gets seized. Regulators step in. Depositors usually get most of their money back. The bank's shareholders get wiped out. Executives get grilled in Congress. The brand disappears. But that's the mechanical answer. The real answer is messier. What happens is a test of collective belief. Can the government step in fast enough? Will other banks stay calm? Will depositors trust that their money is safe even when the math says it might not be?
Most of the time, the answer is yes. The system holds because it's held before, because everyone kind of agrees to pretend the gap between deposits and reserves doesn't matter. But every so often, the pretending stops. And when it does, we remember something uncomfortable. Money, in the modern sense, isn't a thing. It's a network, a shared hallucination, a consensus that these numbers on a screen represent value we can all exchange. Your bank balance is real as long as everyone believes it's real. And the moment that belief cracks, the number on the screen stops mattering. Because the money you think you have isn't sitting in a vault with your name on it. It's out there, somewhere, moving through the system. Lent, borrowed, repackaged, promised to someone else. You don't own money in a bank. You own a claim on money. And that claim is as good as the system's ability to honor it when you ask. Most of the time, it does. But the system doesn't run out of money because there's no money left. It runs out of money because too many people asked for it at the same time. And no one's quite sure how to fix that without breaking something else.